Oh, I don't like to.
I grew up watching. I was like 6 years old on VHS. And then we have a soundtrack.
You asked the first question. I was working out at beach in Elkhart and I put my boxing gloves down to text you. Oh, that's right. It's good. And I like to answer questions. So this was on, shame on me, on like a Friday morning when I probably should have been in the office. So it was an awful morning. I locked myself out of my truck. And I had to walk to work from Beacon because my laptop bag, and it was like a 6-minute walk. And I got there and somebody reports up to me, the SEC reporting manager, technical accounting manager. He drove me to meet the AAA guy. I'm glad that we're recording this, so everybody can know that. But so when we got there, he didn't have his lockout, AAA guy. Really kind of bent out of shape about it. And so Corey drove me back. And then we had pizza, it was a pizza party from Bruno's in the basement. I think everybody was there. And then having a lot of good talk and fellowship. And then John from AAA called me up again. He said, I got it, Dave. I won't tell you how I got it, or and so he's there. But he's already like ready with my keys by the time Michael Gadzik, this nice GMC Sierra, dropped me off. And I gave the guy $25. I'm like, no, John, I need my tip. Great, I'm back someday. Grabbed my gym gear, went back, had a good productive day. But so I had already locked myself out of my car when I was texting you for the homework time. So we call multitasking.
Hey, don't feel bad. You ain't going anywhere. That works out when I'm sitting at work. You know, I do that.
It puts me in a better state. You know, it's like I can show up to work disgruntled, just tired at work, get the work out.
I've answered a lot of emails.
Yes, yeah, that's in a good state.
Either way, we knew the time to see about every year, we just did the six.
And in Elkhart? Oh, okay, good morning. Yeah.
What do you define as a good leader? But it's like a cool program.
Okay. You might also have something before your name, Kara, if you were to be formal, correct? Okay, yeah, so you wouldn't be teaching this class necessarily, but maybe engineering.
I would not be.
You might, yeah. One's one of these local educational institutions for that PhD, right? I've only been to one football game. Never been to the library a couple times. Never did engineering.
I was just a student.
Okay, gotcha.
I'll probably get to this.
And then do PhD students always publish a dissertation?
Yeah.
Might have publications. I'll look that up.
It's real exciting.
It's probably got a couple of equations.
Explosives.
So there's two folks we could wait on, or since it's recording, you know, we could just maybe just do some early breakdown of kind of initial feelings about the homework before these folks come in, or we could just start talking about Twitter already. Anybody see the news about Twitter and Elon Musk? I might have a news source.
Oh, I thought it was offer.
Might have.
It went up.
Now, whether what I'm doing now is going to be recorded correctly. Oh, just share the screen. So what was frustrating last time is I kept saying, okay, we know what the market cap is. The market cap's the price of the stock times the shares, but I kept forgetting to go up to the SEC site on time and getting the shares. So I did it here and I wrote it on the board. We're talking about Twitter because we're talking about this today's class is about equity valuation. And then the homework assignment for the final class project is going to be on valuing your stock with the spreadsheet that I already gave you. Now, some folks maybe took a head start. I know Hubert, you were talking about, hey, should I use Nike? I'm like, yeah, but then that assignment would have been a killer, because then you have to go back in time and it'd be manual. And so for the final assignment, I wanted to give you time to do that. And for this assignment, I just wanted you to be able to play with it, see the conceptually. So Elon Musk, remember we were talking about if you had this much cash in your bank account, you could buy the shares outstanding, which is at 12/31/21, 799,384, multiplied by the stock price, which that's 799 million or 799,000. We'll know by the look at this. So it's got to be 799 million, right? Because if it's the shares times the stock price to get to 34 million, and we'd have to see what its market cap was at year end. Elon's got an iron in the fire, and he's got a 10% stake in Twitter, bought it with his own money. Now, Mike, you said, was it other people's money, OPM?
Yeah.
Oh,
Yeah.
yeah.
Just learned about it today.
That could have been true. Most likely, if it's other people's money, he'd have to disclose it. And then you'd have to kind of know what investment vehicle, what folks contributed to that. So he's probably got the cash to do it himself. He's probably got the cash to buy the whole company or to borrow it, get the financing. I think that when he wanted to take his company private at 420, he was going to use some Middle Eastern money. And he talked to a king or whatever, because I don't think he had that much cash liquid and available. You have to understand, he's only been selling shares recently, so he hasn't had a lot of actual fungible liquidity, which is cash on hand. Welcome. So now that he's sold a lot of shares, do you guys remember how he did that? He went on Twitter and said, should I sell 10% of my shares? Yes or no, vote. The vote was yes, he dumped those shares, got that cash. So now he's got some serious liquidity to do some cool stuff, and he's bought a 10% stake in Twitter. I don't know what he bought it at.
Did he buy it or did he just offer it?
He bought the 10% and he offered to buy the rest recently. Yeah, so that would be, oops, look at that. Okay, so something happened right here. It's traded, hit 32 from a high of like 76 earlier. And kind of so I think this is where he either did his 10% or his 100%. I have a day job, so I haven't been following that closely. But
I saw pre-market, it was up like 15%.
this morning or
When I woke up, yeah.
or with the 10%?
It
Because initially you bought that 10%, then disclosed it.
was like, I don't know if it was announced late last night, but I woke up and checked the stock price and it was up 50% pre-market. I had to watch it throughout the day.
So this is a daily chart. So these are days. So this is today, yesterday. So 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 days ago, I think it was disclosed that he had initiated 10%.
Yeah.
And spiked all the way the heck up. Now, and I think, is he offering $50 for the whole company?
54.20.
54.20. Okay. So you have a lot of capital and a high tolerance for risk and a lot of good quantitative people. You could open up a risk arbitrage hedge fund. Concept of risk arbitrage. Arbitrage is taking advantage of something that you consider to be almost a no-brainer. Starbucks is selling coffee for $5. Okay, I've got a coffee machine in here. No, that's not going to work. Portillo's is selling a hamburger for $10 at South Bend, and they're selling a hamburger for $5 in Mishawaka. Okay, I could, if the gasoline cost was less than $5, buy the hamburger in Mishawaka for $5, drive across the street for the $10 Portillo's, sell it for $8. I've made a $3 arbitrage. And so the arbitrage spread is whatever the opportunity is versus the apparent risk-free opportunity. So if I had a lot of capital, what I could do is I could just buy, and I might lever up my trade. Let's say I've got 10 billion of capital. Maybe I'll put 100 billion on this trade. I'll buy now, thinking that Elon's going to help me out buying at 55. That's the arbitrage spread. Now, if it falls apart, I lose a heck of a lot more than I invested if I had leverage. There's a lot of risk arb traders right now, and they're shorting the stock, putting pressure down on it, they're buying it, keeping upward momentum. But that's what's going on right now because Elon, so the story goes, wants to take Twitter, buy it. blowing all the shares. It still might be public, but he would have 100% control of the board. He could do whatever he wants. He could, his brother, sister, and cat could be on the board of directors, and they could do whatever they wanted to. And I think he wants to change the structure of kind of what their rules are, make it a little bit more transparent or open. I don't know. I don't want to get political about it, but that's what's kind of going on. And so when this went up, I think your market cap, which was the 799 million outstanding, times that makes sense. It's got to be millions, right? Multiplied by what it was there and what it was there. You're seeing the market cap go up significantly. Now, where did I get these shares? I got it from the balance sheet of Twitter. These are the shares in 21 and then the shares in 20, and I got that from the SEC website. We're not doing class 1 over again, but we're going to dive into class 3 by just getting the ground running. So the shares outstanding are on the balance sheet. That's 12/31/21. That's 12/31/20. Bingo times the stock price, which you can get on investing.com or Yahoo, gives you your market cap. So, I prepare for this class by just kind of living the market, and I do valuation every day. I teach people valuation at Patrick every day. So, Chad was asking me about, well, what about Twitter? What about Elon? It's like, I'll give it a shot, so this is kind of what's happening. If the shareholders didn't agree that whatever he was offering was a fair value, he might have to increase his bid, right? To maybe something higher, which would make that total consideration. Consideration is another term for what you're given and what they're getting. Maybe the consideration would go from 50 billion to 70, and then he might not be able to cover that. He might have to go to the markets and borrow, and then we'll see how it plays out. Anybody doing Twitter for their stock? No? An interesting thing to do. Okay. Moving on to, did everybody get a chance to see the homework and kind of review the instructions and take a shot at it? Okay. Look like that. So does anybody want to share kind of how they understood their thought process and then kind of walk through some of the results? I can choose randomly. Hubert, since you kind of asked me the first question while I was at the gym, maybe you could, your question was, don't read the email.
I didn't dive into that. I just played with it.
Yeah, because that would have been way too much, frankly. But it was, I noted that if I changed the revenue at one of the cells, or maybe the percentages in one of the cells, the revenue kind of drove it. Something, was it maybe if I changed revenue here, something like that. One of the cells, I've got it on my phone in text. And that was definitely the idea. If I change percentages here, it's gonna ripple through. If I change the revenue here, now that's formulaic, so maybe if I change the revenue here, that should ripple through as well, is it? Yep, it's hitting that. So depending on what you were trying to do, you're doing steady state growth, which was kind of flattish, or if you're doing a high growth, which was kind of off the chart, sky's the limits, or just reasonable growth or declining, this was going to ripple through. So what's changing and what's staying the same? So when that went from 100, I'll do the back. This is not my, there we go. So who's got the dog chew company? Okay, Lori. So I know that you didn't necessarily use your dog chew company because that would have been a lot of work to go back to the financial statements and stuff like that. Hopefully I can maybe introduce you guys to S&P Capital IQ if I get the license, and it can be all automated. Maybe not. But for the final assignment, you'll have a lot of time to do that. And it'll really just be the revenue cost of goods sold, OpEx that changes. So if you're, what was the company called again?
Art.
Bark, okay. So if Bark was to do, let's say we had three scenarios, it's steady state, growth. Now, of course, the homework for growth though, was to make it grow. So by changing the percentage, right? And then the homework for the decline was that this is just steady state. It says growth, it says decline, but not. So let's say I'm dealing with Bark and Bark's gonna grow. What might be some of the percentages I'd change if I were to do a little growth?
Well, and I did that, I changed them all and just, I don't want to skip ahead, but I just want to make sure I conceptually understand.
Yeah.
What we're doing.
Sure.
So when you had us do the steady state and the growth and the decline, the biggest takeaway that I found, because I did all that, and then the progressively negative, is that weighted average cost of capital is such a big factor that I did like a 50% growth each year. And then I discounted
What might your
that,
WACC be
and
if
then I
it's 50%
discounted that
growth?
by 10%, and it was almost the same. So you could actually lose money each year, and a decrease in the weighted average cost of credit is gonna make you the same amount of money as if it's a 10% higher, but you've got 50% growth instead of losing money.
Okay, you can get up here and finish the lecture. Which is exactly what I and my colleagues struggle with every day in investment bankers, is that when you have moving pieces and it's an iterative process, you can start creating a mess. And that's reality. That's reality in valuation. You get, especially if you're on a roadshow, you're trying to shop a company and raise debt, and they're moving too quick. Let's change the assumptions. And then you've got all these smart analysts that are getting paid ridiculous money, and it's 2 a.m. They're like, wait, it's not reconciling back to WACC. This isn't reconciling back to the required discount rate. Now, the net present value based on the kind of the fundamental assets they own doesn't even triangulate. No one's going to buy it. Won't make sense. Something's going to break, in the model. That was why the homework took me so long to do, is that I was trying to take a real life model, sanitize it and change the links, change the formulas. It wasn't working. I had an analyst, M&A analyst at Patrick, working on it to help me fix it. He's like, I'm stuck, man. And so I just had to create this to make it basic. So yeah, welcome to my world and the world of finance. It's nasty.
Yeah.
So everything you said was correct. When you're doing your final assignment, you're going to recognize that you're going to have to change WACC. If you want to try, so if you're going to do Park and you want to actually start, and I don't know how far their financials go back. If it only goes back 2 years, then you're going to have some projections. We'll talk about that. But if you're doing Bark, or if you're doing Nike, or if you're doing your engineering, big 40 billion, was that? AECOM, okay, that just rolls off the tongue. You're gonna start with your known knowns. Donald Rumsfeld, defense minister, your known knowns, and then your known unknowns. We'll start with the known knowns, and that's what revenue was, right? And then, if you're taking the historical approach, you're gonna know what your percentage changes are, because you can, if it was 100 one year, 105 the next year, you can do the math to find out that it's 5%. Terminal year is going to be your estimate, right? And that's going to be affected by a lot of different things. The cost of sales, if you're taking a historical approach, is what was COGS as a percentage of revenue? So just type in the COGS, right? Operating expenses, same things. It's going to be messy. Maybe they won't have cost of goods sold or operating expenses. And you can say, Jim, okay, they've got warehousing and delivery, and they've got SG&A. Is that operating expenses? Yeah, or maybe not, depending on how you want to define the geography. I mean, there's a diversity of practices in best gap about what goes where. Generally, they should go in the same place. D&A, depreciation and amortization. Maybe they don't have amortization. Why would they? Well, maybe they have some intangible assets that are amortizable. Depreciation is the fixed tangible asset. Income taxes. You have to read the income tax statement to find out what the tax rate is. CapEx. Okay, now I have to go to cash flow statement. That can be a little bit onerous. If your growth is off the charts and variable, you're going to find that WACC is going to have to be adjusted upwards. Otherwise, you're going to overvalue. You don't want to say, like, think about like a volatile athlete. He or she may be very inconsistent, but when their game is on, they are worth it. That's why they keep them on the team. Their weighted average cost of capital is very, very high. Whereas that person hits every free throw, but really can't do much more than just get fouled once in a while, hit a free throw. Their weighted average cost of capital, they're steady Eddie across the top, and they're not very expensive for the team, so their WAC's going to be low. But then again, they're not going to have a huge valuation at the bottom because there's not much at the top to drive anything. If you don't have something at the top, you're not going to have something at the bottom. And so even though you're not going to have a lot of growth variability here, if you're a low growth company, your WAC's going to be low, but then who cared anyway, right? It's those Twitters and those Teslas that are they're starting at 100 and then they're 260 and then they're 80 and then they're 1 billion the next year. And so that WAC's going to be really, really high. And so at the end of that homework assignment, if your market cap at the end of your value or the beginning of your valuation period, it's going to be the beginning. Talk about that. It's way off. WAC is like the plug. It's the thing that is going to change it to triangulate it back to reality. And you still might not ever get it because your opinion and your model still might be right for you, but there's a lot of other market participants. I mean, think about it. The stock market is a living, breathing ecosystem of reality. And reality is people, it's AI, it's machine learning, it's a lot of these bots running, trading, and valuing. And so, having help you if you can really understand this, because this is class. Reality is what's going on with Twitter and Elon Musk. So in any case, when percentages, who else had April? Who did you choose?
I chose GM for universal product. I just like base numbers.
Yeah. Okay. So, but like, let's say you're thinking about GM, they might be more of a steady state, depending on the time horizon. Let's start manipulating. Yeah. It's class, right? This is not financial fraud. So we're in steady state right now. I've got 20, I think, in the class that started 18.2. Okay. So all things being equal, pretty reasonable growth, 5%. Looks like cost of sales, we're maintaining constant as percentage of revenue. Operating expense, same thing. It looks like across the board taxes. CapEx looks like it's going up. What's interesting? If you've got capital expenditures of 2.6 million and you've got depreciation, I might need to double check this. I don't think I have that right. That one might need to go away in the final year. Nope, just the amortization, not the depreciation. So I'll have to fix that. But it didn't screw up the formula. It didn't screw up the model too much. So depreciation, let's just talk about depreciation. That is when you're kind of recognizing the expense of your capital expenditure in the future period. So $10 million of equipment, it showed up on the statement of cash flow as a bad guy in the investing section. And then in the income statement, 10 years later, let's say if it's 10-year useful life, is $1 million of depreciation expense a year. What would happen if my depreciation was higher than my CapEx? That's like a gut check. It would make your model totally all messed up because you'd be eroding your capital base, your productive assets, faster than you're replenishing. So in your financial modeling, you always want your CapEx to be higher than your depreciation. I've learned that the hard way. I've done quick and dirty spreadsheets and run it by a third-party valuation specialist. Gwendolyn, she said, check your depreciation because it's at $4 million a year. Your CapEx start at 2, and it's ending at 6, and depreciation is ending at 8. You're gonna not have anything left to produce assets. So, okay, so what happened in April when you were adjusting WAC? What kind of, do you remember what numbers you were?
Basically what she had said before, like I kept the long-term growth kind of moderate each time because I was trying to be too like, oh yeah, they're gonna have crazy growth or anything. But even like, experimenting from 0 to 10% growth and then whack anywhere between 15 and
Okay, so 15. So right now, so two things are gonna change. Martha goes by Marty. Okay, so you had asked tonight about, question was, when I change WAC, the only thing that changes is the discounted cash flows. And my response was actually two things change, right? So when I change WAC down here, line 29 and line 30 are going to change. So why would line 29 change? Well, let's do it. So cash flow should go up if I lower WAC. Did it. So they went from 168, they went up to 168 from. So that's a nice little increase. But at the same time, the present value of the discount factor is going down while your WAC goes down and your cash flows are going up when your WAC goes down. Why would that make sense? I think that was your question. One. Okay. I might have said that in reverse, but we'll. Your WAC is going to, when it goes down, your cash flows are going to go up. And as it goes down, you're getting more here. This is because this discount factor is basically saying if your discount factor was 1, meaning it's not going to take away, it's going to be giving you everything back, right? If it's 0.5, it's going to be taking half away. When WAC goes down, the price of time goes down, and you're getting more back because risk is going down. Execution, forecast risk is going down. So you're getting charged less for the price of variability. Prince, did you do anything with growth? Anything crazy with growth? Or maybe we could just go to growth and just see what happens.
So to be honest, I did mess with growth,
Okay.
but I was kind of like fascinated how when the WAC would go up.
Okay, when the WAC go up, so we can just do it here. So
Yeah,
we'll go
so
to 18.2 to what?
I went up to like 22.
Okay.
And then so it like, then I increased my growth. So I think when we had originally had it, it was like at 5, or it was like 8, 10% like what the original, like when how you had sent it to us, the original model for the 8, instead of 15 and not, changed it for like, I increased like 10%, 10, instead of 17, kind of like gradually made my way down.
10, 10.
8,
Okay.
but because that WAC is so high, it's still kind of.
Okay, so now we're at 102 with your top line adjustments. So let's go back. So 102, 93. There you go. So you could upgrade your top line growth, but if you didn't play by the rules and then adjust WAC up, you'd be overvaluing your company. So it's almost like you're robbing Peter to pay Paul.
Yeah, that's
That's part of that equilibrium you feel when you're getting to be a valuation specialist. Okay, that feels right. You had people that do this for a living. I work with people that do this for a living. I don't necessarily do this for a living. I work with specialists that I pay. They outside of the company. They look at the stuff. I mean, they're full time, really doing this, all kinds. And in a second, they say, "Yep, that feels right. That seems right," and they know. So this is kind of like the trial and error. Zane, you're looking thoughtful. Zimmer Biomet. What kind of scenarios were you going for?
So I think it's probably similar to other people. I was just toying with the numbers in here, but
Do we go to like steady state or just rewind and start?
so yeah, like with the growth, I assumed the growth of 10% instead of 5.
Okay, what should my WAC be right now?
Oh, if I remember, was it 18.2 nominal?
And then 2016 is gonna be 10.
Yes,
Is it going up or down after that?
I just kept it
10.
for 5, 10, yeah.
Terminal year is 2 or
I think I left terminal at 2.
yeah. Terminal is a hard to understand concept because you're looking at the long-term growth of like the world economy at that point. When you're going that far out, because it's basically that to infinity. And so, and are you looking at real growth, which is long-term nominal growth less inflation, or it's hard for it to be a whole lot more than 2, if not less than 2. So it would be really, really hard to say your company's going to grow 10% in perpetuity, because on the law of large numbers, it's going to equal the world's economy eventually, just based on the way it goes. 10% forever is going to be big, quick.
So as a 2%, maybe close to an assumption of like 2% above market.
Two, and it might be at, it might be at market. Yeah. It might just be, that 2% might be just keeping it going. Keeping a little bit of gas in the tank, not a lot. Okay, so what did we get? We went from something to 142 million.
I have a question about
123.
You have a question in the front row.
Okay, yep.
okay, I was wondering,
Abby.
when you're changing like how much growth a company's expecting or is experiencing, wouldn't that in turn, like when saying like you kind of have to value the WACC accordingly?
Yeah.
So like wouldn't it be if you're growing exponentially through time, their risk is kind of high, right?
Very elevated.
Because it's not gonna continue consistently. So wouldn't you wanna have, like, would you have to like
Yes.
balance those? So in this model, we haven't necessarily been like required to like match those up to an extent. But in reality, you would have to like have like a specific correlation of some kind, whatever your company would value that.
You said that perfectly. Yes.
Okay,
So there is no formula in here that is basically saying like an if-then formula, and I candidly don't. Probably somebody knows how to do it, where it's like, okay, you've increased this by more than a certain threshold, let's say 5% per year. Your WACC should be auto-adjusting upwards,
okay,
and attenuating. And then if you adjust it down in future periods, I mean, to the extent that you're introducing variability, unpredictability, yeah, your WACC should be
okay.
growing with that.
So if you were to like let's just say like the first 3 years, or like, let's say this is like an 8-year model or something, I don't know. But like the first 3 years, it's like a lot of growth, and then it's like slowly goes down to more like adjusted. The first 3 years, the WACC would be higher because it's growing at a riskier rate. But then as time goes on, it would level down because the actual growth of the company is becoming more and more like a moderate and like realistic, or I can't think of the right word.
No, you're all that is true. Yes, you can, this is a 2-stage organ growth model. It's 2 stages. You could introduce multiple stages into it, and the WACC would be changing.
Like where it's like, it's not just
Yeah.
one number for the.
And I've got a great resource online. There's at the Stern School of Business, there's a professor called Aswaf Damodaran. He's so prestigious that when you're citing valuation textbooks like Duff and Phelps, you could just cite Damodaran, and he's got all that stuff online with like, you can value a company that doesn't have revenue. You can value a company that has revenue, but expenses that are way in excess of revenue, startup company like Bark. I think it's bleeding a lot of cash. And so there's literally almost infinite ways to think about valuation, and in your examples is actually Perfect. Did you try to take a shot to do different wax? This is,
I kind of tried it just different ways because I was like interested in it. My notes are not really the best on what I noticed, but I did think it was really interesting because you said it multiple times tonight, or other people have as well, like when your growth is going up a lot, like whatever you have the cost of capital as, like that is really the main thing that is affecting it. Like your growth is crazy, but if your cost of capital is very high, then you're not hardly gonna notice anything change in like some of this kind of cash flows.
right. So we're actually using 2 wax in this model, believe it or not. Here, again, I might need to clean up the spreadsheet a little bit because I just noticed that I was taking 400 basis points off from the 18.2, and I was doing that for another reason. But then here I'm taking another 2% off the final whack that I'm using for the terminal discount. So for the terminal, I've actually decreased whack a little bit. And there's a valuation technique that says that makes sense because since your terminal is jumping down, you want to kind of give yourself credit for that low growth rate. So you're kind of like consider that, given that steady state, you're going to actually decrease your whack by that.
What if you're majorly dumping cash, you're in steady state decline, and you're hurting that?
Maybe you can help us out with that, Marty. Did you try to kill your company?
I did.
Okay. And again, I'm trying to speak to everybody, so maybe if I'm calling on the same people more than once and you haven't talked yet, you might just say, Rose, give you my idea soon. So help me out. How do I destroy this company?
I just get more negative, yeah.
Okay,
Make that growth go down. I mean, I did a whole bunch of different numbers, so you
Okay.
can put whatever number you want in there.
okay, let's see.
But it-
COVID.
Yeah.
That's probably what something like Portillo's. Now over where do we go? 109. 123, 109. Okay, that was not bad. And then look at recovered 5%. Ouch. Should whack become? Variability and forecast risk is going up or down.
I thought it would go up.
Yeah, I think it would go up because the risk is increased. You're saying we're being conservative. You're saying everything's going to be told. Ship show.
It's not good. Your risk is.
Right? Your risk
You're
is-
scary.
Jessica, up or down? What do you think again? Back? I'm introducing a lot of volatility, complexity, and variability.
Yeah, it's just.
Okay, so you're at 18.2. Okay, now we're gonna go. I mean, let's say I've just done this in my model, so I'm gonna, happy to your point, maybe one step at a time, right? Now let's go to like 19 points. This is all we've done so far. Now I'm sorry, it's precipitating. Look at it. That's positive focus. How about negative? Okay. Now let's adjust back in. Ouch. Nose. Okay. It's going to be hard to get a loan for this company soon because its equity is getting close to 0. We haven't killed it yet. What's the final bet now? How many customers? 30%. Dang. What did that? 67. Yeah, but we still grow it. No, if you want to kill this company, let's just assume that.
Growing a little bit.
Okay, now there's something wrong.
I never touched that one, too.
Yeah, here's exactly what's wrong. It's something's hard coded. 1 plus C40 minus 4, okay? Back to this contract. 6. Oh. So. Decline 2%, negative 2%.
When I was thinking like declining, if I put a really low whack, then my company went negative one time.
Interesting.
I don't know why.
So let's try
If I put
2% whack.
2%, yeah. Killed it.
Terminal did.
Yeah.
You can tell I've never really done this in real life. Because if you're in that, if you got a whack of 2%. Fortunately, I've not been in that situation.
You should bring it in what,
What's that?
kind of, they keep the money.
Yeah. This is
Right.
interesting, so.
I know, like, I was like, I did see that happen.
Yes.
I know.
Okay, professor has a little bit of work to do. I can tell you, I've had scenarios like recently where your years 2 and 3 are declining a little bit. So you maybe had like down 2, down 5. Oops. And then some recovery. And then some growth. And then this. And you're reflecting a little bit higher of a whack. B stayed the same. And what I learned is you can have a couple of negative years, but as long as you're eventually recovering and then your terminal's positive, you're fine. I think it's apparent that when you're getting like serious decline, when you're predicting like 0, your whack assumption gets flipped on its head. I need to do a little work on that. There could be some examples in the textbook of this. I doubt it. I think we might be in a little bit of a new territory, but it's a great homework assignment question to ask, because did anybody get a clear understanding of what that low whack might be and why it might be? Sarah, you might have an answer. You bail me out.
I honestly.
Kyle, any insight?
Well, I did the exact opposite.
Oh, okay.
I looked at raising the whack high, kind of in isolation, because I guess one thing that really stood out to me was when COVID hit and uncertainty went through the roof. The VIX is up to 80 points. Stocks are down 30% from their highs. And
You
so,
mentioned the VIX. What's that all about?
Volatility index of the S&P 500.
Tell me more.
It's based on the options of the S&P index.
You ever bought those options on the S&P index?
Yes.
You have.
Yes.
Okay. And so when the VIX goes up, volatility, the price of fear and risk, right? Based on the S&P 500, which is the top 500 capitalization of stocks, what happens to the price of those options?
Typically they go up.
They go up, both puts and calls, right?
Right.
And then if the VIX goes up and then the S&P 500 goes down and you own puts, what happens to your brokerage account? If you own puts.
For what?
If you own puts, not calls, but puts. If I'm stepping outside of what you're familiar with, that's fine.
It's going up if you own puts.
Yeah, and
they're
the
going to 0.
Okay. Typically, I've seen the puts go up in value. The S&P's going down, VIX going up, your puts are gonna go way up in value. Calls, vice versa. S&P 500 going up, VIX is going up, your calls. We can dig into this, and we can go on Yahoo Finance and actually look at what will happen. But that VIX is gonna be tied into this whack, because it's gonna say that the forecast and execution variability has gone up. But I think it gets complicated when you know something's going to go down over time. Almost like knowing that something's going to go up over time. I'm almost thinking that if you have certainty on a decline, that almost means whack would be going up. I don't know the answer. We've seen this in the model that if you want to sink your company, you've got to have low whack and negative growth. So maybe we're coming to a collective understanding through kind of struggling through the answer together. Mitch. What was your journey?
Yeah, so one thing that I was curious on, but I think you answered it, was.
Carrie, you've got to know this because of this engineering background you've got, but gotta have an equation for this. Okay, sorry.
Is the terminal year in the model was lower than your growth rates for the actual years, and you already really answered that. And that was kind of my, you have consistent growth rate, why would the terminal year be lower? But that's based off of, uncertainty in the market over time and all that stuff. So that's where I was kind of looking at, well, why? And then how do you come up with that terminal year growth percentage?
You're looking at the long-term prospects going out from time to infinity. And then you're saying, is there something so structurally different about this company that the rest of the long-term growth rate of all companies that it's going to exceed it? And if that's the case, well, does something else have to be adjusted? So it's kind of like all companies, no matter what, are going to approximate once they reach that, the law of large numbers. Even Yahoo and Tesla and all the top companies, they have this great growth, then they even have to get to a steady state. And that steady state tends to approximate just the long-term inflation, kind of, right? 2% inflation right now. What is it? 8.5. Okay. That's had a little bit of an effect on what? Probably the riskiness and inherent relative values of assets, because inflation, if you remember, I don't know if you guys remember, I showed that CAPM formula, right? So WACC is your cost of equity plus your cost of debt, right? And I didn't want to get too much into the math, one, because that's not the focus of the class. It's more, what is this about? How do we understand it? And also, when I started doing the equations, I don't think anybody was really clicking their heels and smiling, but
I was at that point.
you were okay, good. But the CAPM was pricing in, and this is just how you value the equity, the beta of that stock, which is how variable is it relative to the market. It was also taking in the risk-free rate, and the risk-free rate can be proxied by what the Federal Reserve is doing with interest rates. And right now, the Federal Reserve is raising interest rates because inflation is up. So when inflation goes up, your time value of money, your opportunity cost is going up. Because if the Federal Reserve is charging you 5%, and they're going to pay you back because they have the unlimited taxing authority of the U.S. government, your risk-free rate is going up. Anybody have a mortgage 2 or 3 years ago? Okay, so Abby, what do you think that you might have paid if you had a mortgage 2 or 3 years ago?
I don't know, like on my.
Yeah, you're more. Yeah.
Oh, what's my interest rate then versus now?
Or what was it then? Yeah,
My interest rate then is 4.25%.
Okay. Does anybody know what the average interest rate is right now on a mortgage rate? 5. And I think that's up about 2% from where it was at its lowest, around 3. So that's because the risk-free rate has gone up, and the risk-free rate is what the banks use to lend to all of us. That makes its way into CAPM, the capital asset pricing model that we talked about that at the second class. And so if inflation goes up, and then correlated to that is interest rates, your cost of capital, which will bleed its way into your weighted average cost of capital, is also going to go up. Who have we not heard from? Ted, did you already speak about your pyramid?
All day.
Okay. All day. I think this is like every class I'm like, because it's just, I'm hearing from you so much, then I don't.
Make eye contact.
Yeah, okay, got it.
Like 20 years ago when like a mortgage rate was so much.
Yeah.
When it was like 15%.
Yes, and that was in the late 70s, early 80s, as Paul Volcker was fighting basic. He was fighting inflation. Yeah, my folks were probably borrowing at like 15 and 18%. I remember Jimmy Carter, Jimmy Carter. So when I was 5, my grandmother Alice, who lived 100, we had a like some photograph of George Washington, some plaque, And it was made out of gold, and my grandmother said, do you know who that is? And I said, yeah, it was George Washington, he was first president. But he's not the president now, it's Jimmy Carter. So that was who was president in 1980. Did Reagan take over in 1980? Okay, so he was on. Okay, so yeah, inflation was just rampant. It was double digit, and in order for him to fight stagflation, so you had a sinking economy, you had rising commodity costs. We were like turning into a second-rate country because of that. He actually raised your long-term rates were like 15, your short-term rates were at 20. They call that an inverted yield curve. You do not want to be around when that happens. So if you think about it, like this is a yield curve, right? And this is interest rates. And this is time. And say that this is 30 years, and this is like 1 year. The inverted yield curve, and let's call this like 20%. Let's call this, it's not to scale, 15%, and this is 1%. The inverted yield curve, and this is 1 year, would be something like this. You'd have like a 20% short-term rate. Your 30-year would be 15%. And that means that you can borrow a 30-year and you're paying less interest than your short-term. And they're doing this to force people to save and not spend short-term. And you have an inversion of the yield curve. You don't have that right now.
Isn't that what they're predicting though, that like we're gonna see 40-year mortgages as a result of?
Yeah, so what happened in the 70s, you had this inverted yield curve where you your short-term, trying to take out a short-term loan and pay it back in a few years, it was higher interest rate than long-term. And this is idea is what the Fed is trying to do is they're trying to get money out of the economy very quickly. Because if you take the money out of the economy, it reduces the velocity of money and it reduces all that stuff that can cause inflation, which is people buying crap and stuff.
No more Portillo's.
What would we do? What would you mean? We're doing an offsite on Monday, and I'm gonna like if you spend more than $200 at Chick-fil-A, they'll deliver. So I think it's gonna be like $400 Chick-fil-A. That's gonna be a good. We're talking about data warehousing and data analytics. So if you don't give people protein, they're gonna just pass out in some coma. So hopefully Chick-fil-A. And Portillo's probably wouldn't work because it's like so all that deliciousness would kind of melt and wilt. Chick-fil-A and Chick-fil-A with Portillo's. It's gonna sit for more than an hour. How does it So if we were, so Jessica, if we were to deal with an inflationary environment, I mean, we would probably have a lot of stuff take a hit, right? Inflation's gonna eat into maybe consumer demand, so your revenue's gonna get whacked a little bit, not to think pun, maybe hit. So maybe you're gonna see a decrease in growth. So maybe we do 2%, so that's gonna take a hit. So now we're at 109. Then weighted average cost of capital, we just said if your growth is going down, wouldn't WACC go down? Well, we said no, if there's negative growth, maybe WACC goes down. But here, we definitely have introduced variability, it's decreasing, but if your risk-free rate goes up, WACC goes up. Okay, so now we've got an instance where decreased revenue growth because of lack of consumer demand, inflation, it's recovering a little bit. And we've also increased WACC because our weighted average cost of capital went up simply because the risk-free rate went up. Maybe beta went up too. Let's say this is really starting to slow things down. Hard to get this thing to 0, right? Hard to get, it's got some sort of growth. Even if we made this go to 0. Okay, so it's maybe saying something. If we radically decrease that, I wonder what happens.
So I didn't do this in class or as homework, but I was doing it when you were talking about it, and if WAC is the same as the growth rate or lower, even if you are growing, it goes negative.
Okay, so if WAC, I'm gonna just write this because I'm not, try to be a good listener. So if WAC is the same as or
At or below the growth rate.
below your terminal growth rate?
No, just any, like your,
Okay,
if everything's at 5%.
okay, yeah, right. Then
You go negative.
you have
So you get-
negative value.
Yeah.
Oh, I'm so glad someone did that. No, not someone, because I didn't, because obviously I'm getting seven. Okay, so that's interesting now. My terminal growth rate's 2. And then if my WAC is at or below my final terminal discount factor, which is the second WAC, if that's at or below the 2%, then it'll go negative.
I didn't do it by terminal, but like originally when everything was at 5% except for terminal, I just put in like, well, what if WAC was at 5% and it went negative?
Okay, let's see. Back to 2% this terminal period, see what happens. Ooh, took a hit, right? Now that's at, what about below? Okay. Getting close. So valuation went to 50.1 from 85 when we took that approach. When, I mean, significantly decreased. Now, I don't know what else we have to do to make it go negative. Oh, I have an idea. Let's talk about the other percentages. So let's negative maybe. Ooh, this is not good. -2.
What about the WAC percentage?
Okay.
That's what she's talking about. If you move that down,
Oh.
the 5, so the terminal is nice.
See, so it's a 5.
I think we're having a problem
change it.
because I just was Googling it to
Uh-huh.
figure out. And growth rate cannot be greater than WAC or else it cannot apply the perpetuity growth.
Growth rate cannot be greater than that. Okay.
I'm sorry.
Now, is that the terminal growth rate?
Just growth rate cannot, well, yeah, maybe terminal value, and let me read the word.
Can you hold on where you're sitting?
Wall Street Mojo, it's gotta be right.
It's gotta be right. So let's go back to, let's go back to the back. My regular examples.
I think terminal.
So growth rate can't be higher than WAC. So this is kind of following that rule, right? Growth rate 10%, WAC 18.2%. Actually need to fix this formula because I'm still lopping off 4%. Now it's actually matching up. Okay, so growth rate can't be. So when you're valuing your company for the final project, I mean, that probably might be one of the things to pay attention to, right? Is that your growth rate can't be Professor Abby. Your growth rate can't be greater than WAC. And that makes sense.
But if you take your WAC down to your growth rate, you take off the 4% you have on there, it's not negative anymore.
Okay, help me out there. So I just took that 4%, that was something I was doing on another model. It's
Yeah, so if you change your percentage, if you add the 4% back on it, you're going, well, depending on what
minus,
you're,
because I had minus 4 before we went at
Yeah.
4 again.
yeah.
That'll
Minus
bring it
one.
up. Oops, sorry. Used to be plus 0.4.
We did the 5%.
Yeah.
Okay.
change your whack percent.
It's
Down.
+4, right?
You did -4%, -4% on mine,
That brings it way up.
but then change your whack percentage down to what your growth percentage is.
So originally, I think in that cell, you actually need to take out the +4%. Well, there was.
Yeah, there was a,
In the original model, there was a -4.
Yeah, because I was doing like some risk adjusted thing for previous valuation, so I was taking out 4%. But here, that wasn't part of it, but this is correctly brought down by the terminal growth rate. But I still think we can get there, so if I do, let's just start back here, do I need to do?
Yeah, change that one
Okay.
to,
What's your growth rate up
what's your
then?
growth rate?
Oh, told my growth
10,
rate,
you said
yeah, so,
10.
so my growth rate can't be higher than WACC, but if my WACC was equal to my growth rate, we're gonna see what happens. Okay, got it. So I'm gonna do 10. Oops, wait, I screwed it up.
Yeah, plus this.
Okay. Put that to down. 105, now let's say. So WACC went down. And the valuation went up. Is that what? One?
Yeah, it's not what I have.
It's not what I have either
Yeah.
on ours.
Oh, okay, so this, whatever formulas are happening
Somebody
here.
messed it.
Go
It's
all
not-
the way back to the beginning.
Yep, to restart. New one.
Oh. Share screen.
You can't recreate.
I'll open up the Excel in Canvas, and then I'll open it up again. Then I'll share the screen. So we can see the video. Great playback, guys. Can you imagine the assignment? Carlos Garcia, 23-year-old, works for me. I'm an analyst. It's like, hey, take this massive spreadsheet and clean it up for my class. I mean, if collectively we're struggling, I mean, this is kind of like the human condition against finance.
This is what.
Okay.
So then if you just change your whack percentage to 5%.
Okay, change my WACC percentage to 5%. Point. Yep. Okay. Oh, we just blew up the company.
Yeah.
123, I mean, so this is basically saying that it would generate negative value. It's based on that discount rate, like you wouldn't even want to start your investment.
Yeah,
Just stop it, wire it.
even though it's showing like growth and possibly growing fast and it's growing.
What if we do changes from 5 to, let's say, something what, higher or lower? Kyle, what if I go from 5% and drag that across to something higher or lower, what do you think is gonna happen if those scenarios higher? We're gonna, and I'll leave WACC constant at that whatever rate I've got it now.
Bail out the company.
Yep, okay. Higher, so maybe I'll make it go higher, go 10%. But then 10%, that can be higher or lower than WACC, you can't violate that. Oh, can't, right? Growth can't be higher than WACC, let's see what happens anyway. Didn't bail out the company yet. That interesting. So you got. Practice. Well, it's still less 4%, right?
That's, yeah, that's a number, that's the 4% switch crossing into.
Now that's right. now we're in positive territory.
What fits in there and see what happens.
Get that, but
For what the whack?
Yeah.
this looks right.
You take off the 4%, that's what's causing it to go negative.
Which isn't all of our models. That's-
Yeah, and it should, that last 4%.
That's what's letting us play with it and letting us get to that negative, because if you
Yeah.
take it out, you can't really do it.
So I think my understanding of this model is actually increased. There's a lot of moving parts. I just trying to figure out, turn around so fast, is this cause more confusion or is this actually cause a good, healthy thought process? That's kind of fleshed out the partridges of
So you-
questions.
I guess, oh, go ahead.
I'm saying it's both, I feel like. So
Yeah.
I'm more confused on and something I'm like, okay, that makes sense.
Right.
What is the final?
That's what, that's where I was going.
Are we using this? Cause see, we gotta get some consistency before we leave, if we using this.
Exactly. I agree. And I think that the assignment in the scenario should be very limited. And I'm thinking that if we took a historical approach, like we know what the results are from 2015 to 2019 for most of your public interest companies, right? You can go in and these will be derived from the actuals, right? And then the only thing you'll have to change when you're comparing, so you're gonna be comparing this number to the actual market capitalization at the day you began your valuation, which would be, in this case, like 1/1/2015. The only thing you'd be changing is stuff in this box right here, which would tell you what the implied weighted average cost of capital was on day one of that valuation. That's a pretty limited exercise. And you'd either get there or you wouldn't. If you wouldn't, there'd be at least a couple of things that you did or didn't do to not get the correct answer.
So are we using companies or not?
That was the idea, but it was also to discuss that, see if we ran into any problems with the existing
No, they-
spreadsheet that might limit your ability to get the homework done.
So we go back and take a hierarchical goal, can't even say that word. Past look, historical.
Historical.
Of the years of our company, and we're filling in each of these from a DNA portion, COGS, taxes, whatever we can.
Mm-hmm.
And then the adjustable one would be the key assumptions. That's what we'd be adjusting.
Yes. That's how I do it.
And from there, we give them,
Am I going back to all of like the 10 keys, or am I, is there something on?
If there's two approaches, so I've got access to a database called S&P Capital IQ. And I have the ability to either, I can have some folks on my team, like, if you just gave me all your tickers, it would take them about 10 minutes, to get everybody's historical financials, pop it in a spreadsheet. Or student licenses, yeah, and it would help them. I've got interns coming on board now, but not anytime soon, another one. Many from the IU Kelly School of Business. Based on what's going on in Millbury. Or it's possible, if I can speak with some of the administrative folks, there are student licenses available that should be free-ish or free of charge or something like that. And that would give you the ability to get all that data and just pop it in and not have to do any work. But if you had to do the work, you'd be going. Mercifully, there are 5-year tables in those 10Ks. So you don't have to go to like every Q and every K. And so to give you an example, I'm gonna go back to my safe space of accounting. I can show you SEC stuff. So Twitter, we went to the 10K. Oh, we got it up right now. They've got something in the MD&A, management discussion and analysis. It's the five, it should be their 5-year table. They didn't take it out because this is our first year. They're allowed to take it out. You guys get all this?
All of it. Okay, good. I was like, isn't that? Good thing.
Should be. Select some. Okay. Okay, so this is an example. So I went into the 10K, and so before the financial statements and footnotes begin, the 10Ks are kind of flipped on their head. There's all this writing and disclosure before you get to the core financial statements and footnotes. So I couldn't find it for Twitter, or I'm sorry, I couldn't find it for Twitter. There's a new SEC rule that says you don't necessarily have to do this anymore after 2021, I believe, but you can if you think it's useful. So it's still being included in this company. And so you've got everything here. You've got your operating income, so you know your operating margin. You could take your net sales and your operating income, and you can back into what your operating expense would be, because you already know what your gross profit is. I'm happy to work through that on Canvas to reverse engineer, but so the only typing that you'd have to really do would be about, I don't know, 20 to 30 minutes of work in Excel, depending on how good you are in manually typing and stuff. And then you might be able to actually cut and paste from this Edgar online and drop it into Excel. But you should be able to get all your information you required here. The only other thing that you might have to do, which would be kind of tough, for your CapEx, your cash flow statements typically doesn't go back more than 3 years. So you'd have to do a cash flow statement probably from 310Ks. So your cash flow is here. See how 3 years is where you get your capital expenditures. And then if I wanted to get 2018 and 2017 to bring it to a 5-year, then I'd have to go. I went to my 2019 10K, then I'd have the other 2 years that I need. So there's a lot of different ways to think about it. So the way you get the information is you go to the 10K, you get your 3 years of cash flow information, you have to do another 10K for the other 2. And then you go to your 5-year table for the revenue, for the cost of goods sold, for the operating expenses, and depreciation and amortization. Can't remember if that was in the 5-year table. That would also be something you have to add. You can get that from out of the statement of cash flow, which is probably the best place you can go. So you get your CapEx, your D&A from the statement of cash flows. Your D&A is here, second line. And then you go to another 10K to get the other 2 missing years. So by going to the SEC, I'm able to get this, I'm able to get that, I'm able to get this, I'm able to get that. My CapEx, I'm getting the statement of cash flows, income taxes. You can play with that. Typically, you can get your income tax rate by deriving it from income tax expense in the income statement to revenue and seeing what the percentage is. So you should be able to get that fairly easily from that 5-year table. Did I share through that too quickly?
Yeah, how do you
Yeah,
get a
how do you get
percentage,
income
but
tax?
then you have
How
a
do-
number?
How do you get income tax? Zoom sharing. Well, it looks like it is because it's on the screen. And, yep. Oh, okay.
Yeah, you have to pick up which screen you're sharing.
Where's your factors? Oh, do not see income taxes, so we have to go to the income statement. So I guess it would be similar to the statement of cash flows, you have 3 years. So your income taxes are here. And similarly, if I wanted to get 2018 and 2017, I have to, let's go to the 2019 10K. And that's all of the information you would need that you'd be able to get from the SEC website. It would be a heck of a lot easier if you get it from S&P Capital IQ, less room for error. Just typing in stuff, you can make mistakes. You can get someone to check your work. Most likely, who wants to do that for you? Because then you're gonna have to teach them how to go to Edgar and how to, wire my students. One of my colleagues, Corey, he said, look, it's gonna be so much work for students to start with 2022 as the first predicted year, or 2023 or whatever, because the whole thing's just gonna be a forecast exercise. Why not make it that the crystal ball works in reverse? The historical financials already existed, and they can go learn from the SEC website, they can see what the trending ratios are by looking at the actuals. And then the only thing that's left is really just to solve for the WACC and then reconcile what was the value of this stock at the beginning of the period. So it's Twitter, you can go back that far. 5-year chart. Okay. Good. And so Twitter, what were they beginning of 2015? Well, if I know what their share price was, call it 12.29. Okay, that's close enough. Share price. Say 40.17. Okay, so it's at 40.17 beginning of the period. Times how many shares are outstanding in 2015. So I have to go to 2015 to cheated. So they would have published that 10K in early 2016. And if anybody can find the 2015 Twitter, it'd be faster than me. Go ahead. This is. I want to go to the balance sheet. I want to see how many shares were outstanding. And actually, I want to see how many shares are outstanding. So, that's actually correct. In 2015, okay, balance sheet. Beautiful. 642,385. 385, and that's $1 million. If I multiply that by the share price, that's my market cap at the beginning of my forecast period, which is what I need to compare my end result of all my work to. 642 times 40.17. So Twitter was worth 25.8 billion at that time. Kind of half of what Elon Musk is willing to pay for it now. 25.8 billion. Probably ready to take a break soon. So if I was valuing Twitter, what I would do is I would take, I don't remember seeing a 5-year table, so it looks like I'll be going to the 10K, looking at 3 years of financials, and going back to 10K 2 years earlier, look at the last two. The same, so I'm getting my income statement, my cash flow, building it in there. I should be able to get all this stuff. It shouldn't take too long, right? Get my CapEx and cash flow, I get my revenue from the income statement, I get my cost of goods sold from the income statement, my operating expense from the income statement, my depreciation and amortization from the cash flow statement, CapEx from the cash flow statement. That's kind of all income taxes from the income statement. And then I match it up to my spreadsheet, try to cut and paste it, maybe I have to just type it in. I put it all in here. And then I want to be careful that these growth rates aren't driving the revenue, because the revenue is what I'm actually typing in. So don't fix it. Same thing here, same thing here. Make sure it's not modifying the model. And then I'm going to look at the value, and you know, maybe you're just going to be using what I left you with for this assignment, and you're going to get, let's say, this number, and you can say, not even close. I need to get 25.8 billion. That's a terrible example, but then you would then say, well, what's off? Is WACC high? Is WACC low? Terminal growth. You didn't get that from the Twitter, right? That's no one ever knows what terminal growth is, even if you got 20-year forecasts. So that's going to be something that you'll have to solve for.
So we're trying to get the sum of discounted cash flows to equal the.
Market capitalization at the beginning of the forecast period. Yeah. It should tell you what the implied weighted average cost of capital and or terminal growth rate is. And so you might get lucky, you might have a bad WACC and a bad terminal growth rate that still matches up. And what was the truth at that time? Good question. You get lucky. Somebody in the SEC department at Twitter had to do this in 2015. They did, that was how they're measuring their goodwill. It's a required test. And if it's proven that they can't recover the carrying value of their assets, they actually have to take a charge and write off the difference. Yeah, accountants can hold a lot of power in that. It's about the only time. Is that the accounting professor right there? So maybe we could take a 10-minute break now like we did last time. I'm going to take a little bit closer look at this spreadsheet, think about the kind of questions and problems that we ran into, and then I think we should spend a little bit more time fleshing out what the expectations are for this kind of final project, how we can maybe modify it and kind of flesh out some concerns to make it a manageable, doable thing that we can all share. And again, as you can see, if I was grading you guys on this, I would have to hold myself to my own standard. And so given that there was some variability in Professor Rose's understanding of the model, that's the mercy and grace I would like to show as well, is that it's just about getting through it, getting your hands dirty, the thought process, and you should learn a ton from it. But it's when you get your hands dirty and you trip and you fall in the mud and you get up that you're a better person for it. See, I'm still alive.
We have a final project and a final.
I'm thinking final project. You know, I somehow they let me pass the CPA exam, but it didn't kill me. And I didn't get the best grades on it. I got on the financial accounting, I might have gotten like a high 70 out of 75 needed to pass. Maybe on BEC, I got 93 and like an 89, but it was like there was no, they give this like Elijah Watt-Sells award for the people that get like the 99, 99. I didn't get that, not even close. So while it allowed me to get a CPA license, it was not like particularly edifying experience. Like, I think this stuff is way cooler. Especially when you get that, oh boy, what went wrong? And everybody's watching, so that's when I learned this, so thinking on your feet. Thank you, I appreciate that. I like the questions you ask while I'm trying to work out, so. In fact, it had to work out even harder. I was locked out. Right. Okay, so it's 7:54 now. Why don't we just do like 10-minute, just take a breather. The wind has died down a little bit. Oh, the cherry blossoms are out. I'm gonna delete the Zoom video. Oh, I missed coffee with the chancellor yesterday, so.
Well, I guess you're not gonna have to go today.
But there's something on a Sunday that I can probably make, some luncheon or, I don't know. I'd like to, I tried to make friends with the guy who was in here earlier. He was teaching economics class.
Hi, are you going? And he's like,
You know, he's off and wouldn't quite tell me his full name, and I know he teaches here.
What's happening?
These people are really nice. There's a Mike and a Phil over there, and this time they helped me with the push that was not working on my phone. And then Mike last time actually physically showed up and set me up here and said, "No, you don't need this." But the professors, I think it's split, of course, it's on YouTube, so it's great. It's split between like those who have a PhD and the full time. And then there's the adjuncts, professional background, and they're good, and typically the students like them, but it's well, there's less of a, they don't have that comparison where they say, oh, I know, well, you have this work piece, you have the same like. Maybe that's it.
Well, the problem is, he'll give me the list, and he'll say like, okay, well, there's more people, or we've already got. like,
Yeah.
Those people.
Somebody.
It's like an elementary school.
His argument's very.
So it's like, sure, yeah, yeah, well, it sounds like students.
Wait, I guess it's all changing at the end of this, right? Maybe just averages out. There's probably a ton of engineers.
Yeah.
Just
So, like,
We get like
Yeah, Mike done that.
$1,000 get rid of that.
we actually do like share.
Yeah, latest, you gotta do it.
Yeah.
Or.
Yeah, that's true.
That you wouldn't expect.
Then again, you know, when it comes to.
Oh, yeah.
Oh, yeah. Infrastructure, right, sure. They get better at food issues, yeah, they.
Never go down, right? Most part.
Yeah.
I don't think anyone.
If you're gonna keep going out.
Yeah, absolutely.
The generation gap in our community. I still do see folks maybe wouldn't hire where they're just like.
There you go.
Oh, perfect.
You like being,
Yeah.
it's frustrating to work on.
Yeah. Everybody just assumed that I was thinking like, stupid. And I was like,
Right.
I'm not.
You mentioned a sorting that you work with.
Yeah, yeah.
My service.
So there's a. The actual oil. You need to go to
I actually took a lot of
It does it right here.
Well, I thought it started.
Well, it's funny because the last one purchase I got was like 70.
Oh, yeah, no.
Okay, I was, that's not bad at all.
Right now, it is.
Well, I was like,
Something since I was.
It's not next week, it's the weekend. On the 26th.
And it was.
It might be better here.
Oh my God.
That's why I wish it was a
No, I had
No.
They're not.
Virginia.
Your team was like.
It's just the clientele. Right?
I should.
The craziest thing. He's trying to sell, like a kid trying to sell MREs.
How many did we see?
Yeah, I've got a few cases.
Yeah.
We have like 47.
Yeah.
That's what it should look like.
Yeah, I don't know what it looks
like.
Well, I mean, when I was 12, brought some home, you know, like, this is fun. What, that's a dog? I'm gonna hell of die. There's no Chick-fil-A down the street. Yeah, I always was going for all sorts. I would just not. I like 5 days. I don't know how I spotted it. I would have Cliff bars up. It's so much.
I think
so good.
Even after
Oh my God, I've been avoided it.
There's a few new around.
I tried to do that.
Oh, no.
I think that it's like.
No.
No, I don't get it. No. I did hear. It's like it's like.
Okay.
There's a lot of like I was fading from reality, like I was starting to see the light. You know,
Yeah.
You just go here and
You know, I get what I just like, I know, like, just like,
Oh, yeah.
Well, and that's what I was just.
We might have a challenge.
Maybe I could do Julie instead.
We might have a problem with Brian.
But then, she's sitting there, they're public for 2 years, and I went to PetSmart, and they were private in 2017, and I'm like, just public.
Yeah, there were some outposts there. Yeah,
I'm surprised I can remember this stuff.
when I take a shower in the bottle of water, like, just, or the.
Oh, this is challenging. They did. Mark was one of these like reverse mergers where it was like this company that existed before. And rather than starting up a brand new company, they took control of this maybe shell company that wasn't doing much. Changed the name, issued some new, I think that's what happened with Bark. So Bark is just got started, right? Okay, yeah. Yeah, sure. If you try to do yours with Bark, it's gonna be an exercise in forecasting, which that's gonna be, I mean, so then you won't be able to notice what happens with valuation. Whereas the other exercise would be an exercise in trying to figure out valuation. A little bit of forecasting. I think I know what I want to do for the rest of the class. I think I know what I want to do when I grow up.
Sounds like.
Yes. So did anybody break into the Starbucks and make themselves a coffee? No, because that would have been. So, when I worked at KPMG, there was this really brilliant audit partner named Jim Bickle, and when he was talking about the quality of work papers or the quality of the audit program, he said, you know, I want depth, not superficiality. And he said, I want inch wide, mile deep. So you're not superficial, you're just covering an inch, but it's a mile deep, the breadth and depth behind it, and think, you know, I can try to impress you guys with, oh, I can show you this and this and this, but let's try to focus on, I think for the rest of the class, and then for the last class, looking forward, if we just focus on one type of exercise and also focus on, before we get started, what could go wrong, we could, I think it would be a good idea to if everybody gives me their ticker and I could say, you can probably put that into your model. We'll spend a little bit of time saying, okay, so for Lori right now, bark, right? Bark is worse than its bite. Oh, he says it's not gonna, this ship's not gonna sail. It's not gonna sail. Why won't it sail? Well, it just started, and the historical income statement is gonna go back. I don't even think 9 months, or it's like 2 9-month periods. So it's it doesn't go back 5 years. And so, and then what happened? You're another proxy, which was
Yeah, Chewy,
Chewy,
and they're just 19, they went public.
19, 20.
Then I went to Petco or PetSmart, and they were public, they're public now, but then they were private in 2015, so they haven't been.
No, you're not gonna have any consistency, and your market caps can get screwed up, and, okay.
Yeah.
So if you're there, you're not gonna be, that assignment won't work, and so, but there's other, you know, so it's, you know, publicly traded company, something with 5 years of recent history. Trying to think. Is there like something that's like a veterinary medicine? I don't know if that's sketchy, you know, isn't there pet therapy? You can actually pay somebody to walk a dog, now you're all. Okay, yeah, no, I need a chocolate lab.
I pay somebody to walk my dog.
Yeah.
Fresh pet, look up fresh pet.
Okay.
FRPT.
And I can add 5 years, look at our chicken.
That's a 17. Oh, that's smart, right?
No, we got 5 years here. And I'll let you start with this first. So the most recent 10K is gonna have a 5-year table, but again, as we've seen, it tends to leave out a lot, so going directly, let's have photos. Look at this, is that dog joy? Look, they have dog joy. It's natural. It's natural. They've got real food, that's for cats. This is a feel-good story, everybody. Just when we thought it's darkest before the dawn, now people like. Feel-good story, and the stock's kind of crazy.
Why is
Look at wasting money on stocks.
Really?
Look, it's got some 5 to 5 year, no, let's just look at the years. So here's the 3 years, right? So this is how I'd start. And then I've got my cost of goods sold, I got my. So to get to my loss from operations, oops. Landmine. Okay, but I mean, you can still build the model, right? Your WAC might be challenging, but your operating income's negative. Ouch. Real
How
life
about
fitness.
this one? Can we pull up Pet Smart? It's Woof. Is the-
Oh, that's cute.
Now that's gotta be
Okay.
a good.
That's our Lori
Nice
Wolf.
to hear. Woof.
Is that how you show stocks too? I really like this thing. That's what I'm gonna start doing.
It's right there. Yeah, so Edgar is, why don't I, how about this, since we're recording this, it'll be at 8:12, so if we started the class at 6:30, that'd be like an hour and 42 minutes into the class. So okay, how to use Edgar. So we start by going on the internet, and you want to type in SEC Edgar. Okay, and okay, it looks like the first hit is probably where you want to go. And that's exactly where you want to go. Now I can look up tickers if I know what my ticker is. If I don't know what my ticker is, Edgar's not your good place to go. So you want to go to Yahoo Finance is where I go. If I don't know the name, Woof was the ticker, but that wasn't the name of the company. The name of the company was Echo.
That's smart.
That's smart.
Oh, no, Cole is not. It's Pet Smart.
Pet Smart is
Pet Smart is private, Petco is public.
Okay, Petco.
There you go.
And then it told me that Petco is Woof.
Oh, that's not it. No.
This is
That's
real
the
life.
one that was
It's good now.
It's
It's got a decent market cap right now. Maybe it had,
We don't have 5 years though, because they were private at that time, that's what she was saying.
Then I'll refer to Lori's other quote. Oh. I said that on a Zoom call today, actually. Okay, so it might not even be, it might not even.
Oh, it is. That's smart. That's, I gave you the wrong ticker. It's
Oh.
PET. I'm so sorry to take up so much time.
Pet
you
med,
guys.
oh no, wait, no, this is good, because this is, you've got a difficult example, and so by going through your example, everybody that has these examples say like, oh, at least I wasn't in Lori's shoes, the challenges.
Well, people say that more than you know.
What about the professor that said, I'm a fancy pants accountant, and then he drops that ball and even do well in front of 16 people. ATM, I don't see it.
Next time.
Oh, okay.
It says NASDAQ. And again, now you're gonna find out that their companies are going private, they're going public. When I worked for Kinder Morgan,
Can it
in
trade
Lakewood, Colorado.
private?
Which one?
Can it trade if it's private?
Probably not, and you're not gonna get the information you need. There's something that it could be trading on like the pink sheets where it's kind of like, you only get a few trades a year and it's not very, very liquid. But once in a while, Yahoo Finance will give you a little bit of information on it, but they're maybe not timely filing SEC financials. And that's where you'd be getting them.
Well, it says it trades on NASDAQ, so.
So it was public, then went private.
It could be, I haven't done the research on it, but it but yeah, let's try it, let's just go here. Which one was it? PTM?
PETS.
Cosmetics?
1824860.
Yeah.
Is it?
No.
Yeah, so I can't find it on here.
Where's the one? Straight.
So you might run into that.
What about Purina? That's gotta be in business.
Yeah, it's owned, yeah, I've seen it. It's owned, I think it's owned by General Mills. It's owned by
I'm
General
just trying to
Mills.
stay in the same.
I think it's owned by General Mills, but I'll check, so.
Oh.
Purina. And then General Mills might be publicly traded. Purina, nutritious dog food. You don't see the investor website, but you might see who owns Purina.
I tried that one. Yeah.
About Purina.
You did?
Something screwed up.
Oh, it's pharmaceuticals for dogs.
There you go.
There you go.
Okay.
Pfizer owns it.
Oh.
Parent companies are like Harper medicine.
Oh, they
put
Let's do that.
This is getting less and less cute.
It's not cute, it's functional.
He's getting a lot of practice.
Nestle went out. Nestle, okay.
What is it?
So why this?
CTZ.
I think Nestle bought it in 2001.
We found another one, CTS.
BTS.
It's pet pharmaceuticals apparently. That's it? That's it.
Why the furrowed brow?
It's, well, look at its market cap. That's extraordinary. What on earth did it do?
They make pet pharmaceuticals.
Okay, there you go, pharma Pfizer. I mean, I saw this lecture, or read an article, or the lecture was about the article that this person had read. And that said, when people go in and get their own medicine from a doctor, they're X percentage likely to follow it. When they get it for their dogs, it's like 90%. You know, they're gonna follow it, they're gonna take out a loan for their dog, and they might not even buy the medicine for themselves. So that's why their market cap is $88 billion. Because people will pay their bills for their pets. I mean, it's just unbelievable. I mean,
It's Pfizer's pet line.
Ah.
and there's probably some relationship with like the FDA on approval, even probably for, I don't know. Yeah.
DOGZ.
Oh,
I like that one. Yes.
This looks like a really good candidate for you, right?
Yeah.
Okay, and it's got all that beautiful runway at DOGZ, could be, we'll just see maybe some.
Yeah, I'm liking the CTS. though.
Okay, I'm in that camp as well. Dogness International, I mean, great, very low market cap, I don't know. Oh, it does not have 5 years of financials, it does not, because I just hit the max, so I think your
I think we're going with.
your
the-
drug dealer for puppies is the way.
We already did that.
Is there,
Thank you.
is there rehab for puppies? What is that, a mic?
Yeah, there's a couple.
Okay. They're listening.
Yeah.
Even though we'll see.
It doesn't pick up well.
Mitch, I'm just curious, is there running a couple for your?
You got that buy in that cup.
Isn't Twitter trying to buy Tesla?
Yeah.
Or is it Facebook? Can't remember. All those, you guys see any more Teslas in the hall? They're driving, I haven't heard of them. Zamboni Tesla.
Oh, there's Zamboni back.
So, okay, so no problem with Tesla. You could have an issue with, I mean, the historicals are fine. But how are you gonna, put all this stuff into
I might
something?
try to find something that's a little more stable over a period of time. That's.
Oh, so you wanna just ditch Tesla? That's unstable, you wanna just say, I'm gonna have more luck with steady state, right?
I just use them as on the first example, because I know it'd be interesting to look at all of the ebbs and flows and, you know, tweets versus, you know, value of stock and, you know, all that, so.
Is he gonna be limited in his ability to tweet about Tesla now that he owns Twitter? Twitter?
Open up the floodgates.
Do you guys think he lets Trump back on? Yes.
Oh, for sure.
Yeah.
I
I think it was just, they were opening and closing the gate so arbitrarily, you know, for whoever their viewpoint was, and so I think he's trying to say, just like, as long as you're not screaming fire and crap either.
So I think he's okay with that.
You might even still put it
I would love that.
Yeah. Clinton's on there telling us about the Ukraine stuff.
Yeah, that's tough, that'd be tough.
I mean, there's definitely some random motivation all of a sudden just to go by this.
Right.
And
So-
so
On the Twitter page, it should be, what should Tesla's weighted average cost capital be? And then everybody votes on it.
Yes, yeah, that'd be great.
Kim Jong-un would do that.
If you wanna get an A in your homework assignment, just post it to Twitter and get everybody to answer it for you.
For data,
Yeah.
like the edit button on Twitter, that's pretty genius.
Yeah.
He's asking his people what they want, seems like a good owner.
Okay, so maybe, so you're out of the woods, at least in terms of your 5-year and the visibility, the availability of financial information. That was class 1, you know, financial information, how to read the financial statements. Now we're running into the valuation, it's kind of like the T-bone intersection, is valuation and reality. You got your 5 years, but what are you gonna do with WAC? What are you gonna do with terminal growth? I mean, that could be challenging, or wouldn't it be hilarious to actually do it that way and you're saying, hey, look, I just value Tesla. How about the rest of, you know, like
That's definitely gonna be me.
like Tesla, mic drop, sit down.
Yeah.
Or maybe not, okay, but I get it, whatever, you know, whatever you end up choosing is probably gonna be the thing that helps you the most. Yeah, so, yeah. So Jessica, any concerns on your
No, I have Disney.
Disney? Yes. Yes.
Parks are back open, so we can watch that. Yeah, yes.
They didn't go public or private or doing crazy.
No, like 1964 or something.
19, okay. Yep, world of laughter, world of fun. Awesome, and they've got, oh, look at that sporting market cap, 237, even Elon doesn't have enough to buy that sucker, right? But maybe he buys 10%. I'm possibly 23 million. So let's just keep going around the room. Nike, probably not a problem.
That's easy money, man.
That's easy money, okay. April, what about,
GM.
okay, that's probably fairly easy money, and Prince, Nike, same thing.
Yeah, I've done Nike.
Easy money. Sarah? what?
Adobe, I already found it.
Okay, perfect, that's great, that's,
AEP.
any issues there, Kyle? No? Same? You're not using Zimmer, right? Are you guys?
Yeah.
Why not? Okay. Mike? 5 years. Target. We've already worked through that, or it's already. You think you're okay? Costco, no problem, Abby, that's probably 5 years, right? I was like, did they have a couple hiccups, bumps in the road, stub a toe? See what happens. Yeah,
I'm just really successful. That's.
yeah, and then Kara, you've got that crazy engineering one, didn't they go public recently, so we're gonna have a problem with that? Did Elon tweet about how he was gonna sell his existing 10,
I don't think so.
swap it out with Twitter, what was the ticker on that one?
ACM. ACM.
and then BCM. BCM.
No, I just would anecdotally share with everyone that
Oh.
I just lost an engineer to this company.
Really? You can get him back. Unless it was like, he was visiting the plant and the arm got sucked in and then the rest of them, that would be literally losing an engineer. But it sounds like it was a human capital retention type of challenge for you. So how can we better retain those engineers? And then, okay, so I went to that SECI group, because you remember somebody asked me, how do I get to it? And then so you got here, after I clicked on the first hit, and I'm assuming I know my ticker, I do A to the C to the M. Now what do I do? Now what do I do?
It's 10K.
Okay, why the AK looks good.
10K has 5-year financial.
Oh, okay. Or multiple 10Ks strung together is good. Like, which one? I can choose the latest one because I know that those are giving me the last 3 years. Then since I know I need some more years, I could go view all and I could choose like the one from 2019 because I'll give me the last 2 years. And it would be filed in 2020 because it's not ready until the beginning of the year previous. So maybe this one, next quarter, annual. Okay, maybe they're not calendar year end. So
September.
I was gonna say, I think I
Oh,
saw the end.
okay, so then there's that, right? You cross that bridge. And then let's go back to, and it's gonna get confusing because all these browsers. I never took a class on multiple browsing. I think what they got the ESG stuff in here in the MD today. Think and act globally at school. It's environmental social governance. SEC is actually requiring companies, publicly traded companies, to formally put that in beginning in 2024. 2023 data is stuff that companies are going to have to capture. It's like their impact to the environment, their quantification of it, whether it's good or bad. I'm in that boat right now, working on an ESG committee. It is onerous, but it's a good challenge, right? Take that stuff seriously. But then it's going to have to get subject to audit potentially.
There's still environmental engineers that live on
Yes.
I have a problem possibly because Under Armour is like heavily declining, like very.
You do, could. Yeah, oh, short that sucker. Yeah, and then who is not gonna be able to help me with questions on declining and whack and all that good stuff? Yeah, okay, I wasn't much of a help when we got that scenario either.
Just like.
So. Yeah. It'll be interesting. I mean, you could take a shot at it. And then you could also try something else, but then that's like double class project.
I think you're overestimating how much time I have.
I'm so appreciative that, I mean, you have lives outside of class. This is a late night class to begin with. I can barely make the drive down here, based on much less get through the class, but I'm trying to check the emails.
What's in the call?
Yeah.
And we're still trying
This is there any left?
I kind of think maybe the samples and rice. Just
What do they put in the coffee? The Irish coffee?
Really?
Wouldn't that be soothing?
It's the ice bucket.
It's the ice, yeah.
No, the bucket that you put the ice.
Oh, the ice bucket.
The unknowns from the coffee.
Got it. Wow. And that could be challenging. And who else had 5 years, but maybe not out of the hot water? Tesla, you were just saying.
Yeah.
So, okay, so, I would, be thoughtful about it, but not too thoughtful because they don't have that much time. So, I don't know, maybe GM again. Okay, so yeah, that GM would probably be less challenging depending on the period you're picking, so. Okay, so you get to the SEC site. And so is it the engineering? And okay, it looks like there's some other data. Oh, this is fairly fulsome. Oh, this might be all you need. Revenue, cost of revenue, restructuring costs. Where's your income? Okay, so there's your operating income, right? You do your, and then you've got your income tax expense, beautiful. Yeah, you might be able to get everything you need right here. And you'd start what? 1, 2, 3, 4, 5. You might have everything you need. And then you've got your shares outstanding. Then you got your DNA. You don't have your CapEx though, so maybe you need to.
It's on there.
Yes.
CapEx is like
Where's your
number
CapEx?
3, right under.
Yeah, should
Oh, this is okay. Everybody should choose this company.
You gotta learn here sometime.
Yeah, yeah. Share answers.
Maybe
Um,
switch to that one.
Yeah.
This is actually pretty cool, Carl. Is that why you chose it?
Yeah,
You're like,
we're not.
you know what,
Yeah, I am.
Rose, I'm gonna help you dial in your teaching, you know? This is what you call an easy button. S&P Capital IQ is an easy button that's even easier than this, because it just bam, just puts it in there, so. Very unlikely that I'll be able to get you guys all circled up in S&P Capital IQ, but for the next like 3 days I could. I'll post that on Twitter.
That's follow up.
You just make a TikTok.
TikTok. I've never done the TikTok. I did Snapchat for a year.
Should have your insurance. I think your employees.
Try it out.
Your employees.
Oh,
Your
yeah.
interns.
There's social media. So Patrick does have social media, a brand new website, the Better Together, and I'm a huge believer in that. And there's LinkedIn posts, and then there's it's a photo of me riding a bicycle wearing this fluorescent yellow helmet. It's just so embarrassing.
Safety first.
Yeah. And then what was worse is that it was in this bike, because I used to be a competitive cyclist, but now the tires aren't inflated. And so we're wearing like deflated tires while wearing like super business cash, nerdy hat, like a dress shirt, and then the tires are flat, like what? But nobody noticed it because it was kind of cropped. Anyway, more momentum in 2022. So where can we find that?
I don't know, it's just my route.
If I wanted to do just a company, do I first sign in?
These is your IC.
Apparently you do.
Okay. Not opposed, right? So it would have been in possibly October. Do I just scroll down? Timeline? It was like bicycle safety month.
Bicycle safety month?
Yeah. When's bicycle safety month?
Why is it birthday?
Oh. This is the impact group that May cycled under me.
You really wanna see that.
Yeah, for sure.
I'm invested.
That's Logan Klein, that's Grant Clady, that's Cassie Reyes, that's Hayden France, it's Daniel Lewis, otherwise known as Louis, that's Leon Gopal. And these were they did 1 month rotations, two at a time. Or that, these are the folks I mostly spent my summer with. So now they're all managing plants and doing the sales stuff. So. Anyway, that photo's enough. We don't need to show the.
Oh.
It's okay, I'll find it, I'll post it.
Oh, that's Jeff, he's present. And that's where I work, and my office is right there. Yep. Sharing is caring, right? So you know, we're always trying to message about how we give back to the community. That's all.
It was last year.
Kids are close.
Yeah.
So,
This will be the most embarrassing.
He decided to.
Remember that? Brandon,
It's like.
Brandon, he lives in my apartment complex. He's our head of business. Yeah, his office is next to me. They're chief information. officer. Great guy. That was 6 months ago, so we're about to get close. Yeah, the left one. Jim, explore relevant terms. All these. Yep, there's Sarah. Well, I don't know if I'm able to find it. Oh.
When is bicycle safety month?
That's a great question.
They say it's May.
May?
We know we're in one, almost like, cause look at all the masks. Yeah.
I got it.
Excuse me. Here, what? How do I? Oh no. Terrible. Oh no.
You totally have a computer bike thing going on.
Yeah.
And you can see the tires in it, by the way.
Oh no.
Exciting.
Oh my goodness.
Was
Like
that
those
even
black,
your
the
bike?
brown
Okay,
trousers.
you gotta still scroll down, cause we can't see that.
Oh. So where do I go from here? 10 months.
Aren't you gonna sing the link?
Wait, so this is 1 year, so I need to go 10 months? Up then?
yeah, it's a year right there, isn't it?
Right,
Oh wait,
keep
6
scrolling.
months, 6 months, care cams. 1 year. Oh, it's random.
No, it's going,
Date
keep going.
posted. Okay, here we go.
No, that.
Yeah.
Not as helpful.
Cause it's not doing chronological, which I think.
Right, sort by.
You
Right.
well, you also just searched Patrick Inches, did you open up a company and then were those specifically?
Now, latest is gonna be this way, so now I go, oh, I know it.
Chronological
Yeah.
at least.
There you go.
So if I do 6 months. All you can get. 1 month, 6 months, oh, it's gonna be lots of. I held that baby not 2 weeks ago. Miles is his name. Yes. Patrick. No, Patrick. And mask. Huh.
Sarah's coming.
Okay, we're getting close, folks. See how I make a total
Social media to me, chill out.
Okay, now we're getting close.
They're family, we can be.
You want me to just mention you, say, hey, at Jim Rose, you're one of the good.
No, it's okay. I mean,
algorithm.
I can't prohibit you from doing that, that would be kind of funny. Almost did. Based on the helmet. 7 months, so I passed.
No, it's at 10 months.
Oh, it's
It's
at
10
10 months. People that I work with directly.
Patrick.
Boats, we're big into boats now. No boat.
Everybody.
There's an RV. Is anybody on an RV? I got a camper. Boats. Oh, we were so close. Yeah, this is Montel Williams show that building. What's your house?
Well, that's for Chinese people to get English.
Are you on Patrick?
So they don't end up with like.
So Jessica, I think I passed it. You guys saw it.
Go to like chest practicing, like and then Chinese people have to English because they're the one. Click on right there, so I can find to send it. And then go to their guys.
Tequila,
And then
somewhere that's.
and then just scroll.
Yeah, tomorrow.
I posted it on campus.
I almost wanted to just prepare my final speech.
Oh, they're not in order.
I thought I tried to get the one from LinkedIn.
5 months, 4 months, 11 months.
No, they're mostly, they're pretty close. There's just ones that got traffic later.
Later, that popping back up.
Yeah.
Like if we all comment on the
Keep
bike.
going.
post,
So if
that
you
should
post it
pop
to
up.
Canvas, you post it to Canvas, so then if I just find Canvas, then
Yeah.
You got a new announcement.
I tried to put it in announcements, it wouldn't let me.
Oh, okay.
Where is it?
It's a chat.
There it is.
Oh, yeah.
I'm living in a big city or a small town. You look so serious. Biking to work can be a sustainable way to travel, especially from Granger to Elkhart.
It's not until legs feel after this bike ride.
Yeah, I felt like my carbon footprint was definitely reduced.
That back tire is really.
Principal Finance Executive Jim Rose is a passionate cyclist, and in recognition of biking safety, Capitalized Jim is asking that drivers maintain an awareness of bikers as they're running them over. Beware of who you're running over, and share the road.
It's like, it's.
Your tire's flat.
You might as well rinse the tire, you probably have those tracks.
Cannot do that photo, can you now?
You don't look passionate.
You see the cycling shoes? I mean, really,
Definitely, you're clipped in, I can tell.
it was hot that day. You can tell that there's a nice sheen of grease and sweat and nervous.
Just went from riding on the
You were very sweaty, your face, you look like
I used to work on that flat tire.
And Erin Wagler was taking a photo with the camera. She's just figuring out for the first time. She's, do it again. Like, do it again. And then so it turned like the tires are almost coming off the rims. And then just like, so this is like, so Patrick is right there. The learner theater is right here. This is the Hotel Elkhart. And they're still doing construction. So I had to like go out because they had blocked it off because they're doing construction on the side. And the police are coming, the police station's right there. And they're like, he's just wearing a helmet, but no hand signals. Anyway, last one passed. And how many likes? 50 likes, that's great. Aaron owns Westman Brewery. And I hosted something there. And so, the guy is your beer slinger, he's is liking your bike safety, so.
He's just
Where-
renting up.
where's
Yep. Oh, well, so if you wanna know about Westman Brewery, just wouldn't you just do this?
Westwood Brewery.
Snap. There you go.
I haven't heard of that.
I've never heard of that.
Yes. There's nothing non-alcoholic there, so there's, I've been there, limitations.
I don't know.
Yeah, so a lot of
Those
things.
hours there.
Where is it?
It's on Plum Road in Elkhart. Close to Elkhart High School. I can't remember which Elkhart High School, probably about a mile away. Near Elkhart Grass, which makes the firefighting equipment on the same road. About 3 blocks away in a warehouse that's fairly nondescript. Yeah, pretty good parking, and that's what this is what exactly, that's it. That's the parking, and Brass Elk is, whatever the brass something, the Elkhart Brass is like that away.
We should do our final presentations there.
It can host.
It hosts events, it says services, upcoming events.
Yeah,
deals.
we can show up, but if we reserve it, I don't think Aaron lets me do that anymore because too many people, but actually this size might work perfect. So. Yeah, no, I'm not, that'd be fun, so.
Announcements.
Okay, so let's see here, we've, anyone else had a company that, okay, let's pressure test it for, can it go on the model? Anybody else wanna kind of walk through? So there, yeah, Marty.
I can't find something, like if it's not gonna go through your model,
Mm-hmm.
just,
Give me an example. Should I pull up the model or pull up the SEC website?
so we're filling in each of the rows, so I took 2018 to 21.
Mm-hmm.
And, plugged in each of the revenues, I won't do anything with the percent growth, right, or do I change that based on what it did each year?
I would say that you
Calculate
could leave the percent growth blank at first, enter in your revenue numbers, and then do a formula to capture the changes, just so it could visually inform you. That's how I do it.
What are you saying, zero it up?
Yeah, and you can then create a formula to capture the changes, or if that's not really in your interest.
So are we gonna use this same spreadsheet from the original thing, or are you gonna clean it up first?
Okay, so who thinks that it's not so bad, and if you guys cleaned it up, you'd learn something, raise your hand. Okay, so I'm thinking that I need to do some work on it. Okay.
Well, is it really just,
Fill it in.
isn't it really just taking out the -4% from the bottom of the
Probably,
assumptions?
and deleting the other two tabs.
Yeah.
That's-
Yeah, so we use the steady state one, we take out the 4% that's down in there, delete, and then,
You're okay with fixing it yourself?
So then.
if that's all I have to do, if there's something
I
else
think
that's
that's all you have
hiding
to
in there
do.
that I don't know about, then I might be in trouble, but.
Yeah, and then maybe, if you guys could take a shot at kind of fixing it yourself, and then, as Gene said, if those are the only two things you have to do, then if it still won't work, you're still having problems, hit me up on, Canvas and email and say, look, this is still not working, and then maybe I can post a Zoom video and say, okay, here's what I did to fix it, and I've posted the new spreadsheet. But it might be a good learning to fix it for me. I mean, if you guys were able to help me find that glorified LinkedIn post, you've already proven your worth, your ability to do the miraculous. And then, so you have the information from the SEC website, we know to get there. Yahoo Finance is just useful for just your general information, might help fill in some of the blanks. Get your model, but then how do you compare the value of the company that's kind of the external value to the internal that you're calculating? How does that work? Where do you do that? Where's that at? So this one is what your internal valuation is, but wouldn't you want to compare it to what the market's actually saying? How's that gonna happen? So then I might need to actually put something in this spreadsheet.
So if instead of putting the cost of sales and you do the percent revenue, because cost of sales is showing C5 times by C8.
Yeah,
So I
so
need to put in
so your
revenue.
percentages, you probably have to clear out or
But-
reverse engineer for the actual cost of goods
It's
sold.
fine if we clear out our formula.
Yeah, that's fine,
Okay,
that's fine.
I was gonna say, just take them out and start with current.
But if part of the exercise is to say, okay, I'm gonna determine how I need to change my WACC based on reality, I'm gonna have to know what my market cap is at the beginning of my period,
So you
beginning of
put
my
in or you have
So operating
How would I do that? So the concept of what the market cap is at the beginning of your valuation period is what that share price was on, like, say, 1/1/15 or 12/31/14, it's just the same thing. What the share price was multiplied by the shares outstanding. Shares outstanding you get from that balance sheet that ends the day before your period begins, so if it's 1/1/15, it would be 12/31/14. Multiplied by the share price on 1/1/15 or a day that's close to that trading wise. But to get to that trading date, it might be a little bit difficult to try to hover over the chart like I tried to do. And yeah. So this is a way where you can pick your time period. And it can be, that's your earliest period, it's your latest period, so I can make my earliest period start date, call it 01, 01, oops.
So my fiscal year ends in September, so should I do it based on my company's fiscal year?
I think so.
Okay.
I think that's how you can do it. So September. And then my year, I toggle out, you get 2015. And then I do this. Okay, that worked. And then, okay, to the most recent date, which would be today, that works fine. Done. Apply. Download. It's gonna spit Excel to the left hand corner. Ah, there it is. Right hand. And maybe I want to drag over the date, so I can see it. Okay, so now, if I'm, let's say my beginning period 9/14 is the adjusted close is 26.9. And then my shares outstanding are going to be the balance sheet right before that 9/14 period. I need to go to see for that. Twitter, 10K in 2014. So, oh, wait a second, yours was September, but your company wasn't Twitter, yours is.
PDX. But. That's
BG.
PDX, but you can show me on here.
Just trying to, oh, I'll stick with Twitter because I think that's the spreadsheet I pulled up here. So, and then Twitter, let's just go back to how many shares we thought they had one of those periods. I think it might have been like 642 million.
What's the 26.9?
The share price.
Okay.
The close.
Yeah,
And
yeah.
and 9, okay.
So 600 and something million, 642 million. 642, 1, 2, 3. Legible, add that. and then equals this times this, and my market cap. And I make it legible 17.3 billion. So that's just. Obviously, this is not correct because I don't think I matched my balance, the correct balance sheet. But let's say I did. That would be the value you want to put into your spreadsheet here equals. And then your difference. Now, of course, this is apples and bananas, but let's say your internal valuation was, let's call it 16 billion, and your external was 17. To solve for the difference, assuming that this exercise is working perfectly in an aseptic environment, you would adjust your WACC or your terminal. I think that's how I would begin. That right there is going to introduce some work, some complexity. Maybe part of the final project is saying this was the final challenge, and I had to do some pretty radical things to even get there. And it did or did not make sense. I think that's the.
So our goal would be to adjust those numbers.
I think that you're adjusting this guy, your WACC, which would then thereby adjust your WACC discount factor, and then this terminal discount factor, I don't know how much adjustment that needs, but maybe some. I think just by focusing on the WACC might be the direction we would take. Yes, and then so you can see my market cap. If I go back to my formula, control left bracket, control left bracket, pops it up there, hover over on that. What's this? Where did this come from? That came from this whole Yahoo Finance. The download historical. And I will be more than happy to answer questions, an email, and then maybe post another short YouTube video on how to get here. We could do a Microsoft Teams meeting offline, and say, hey, crisis, I'm at the Gucci Martins in Heritage Square, and I've got my laptop, and maybe some of you guys are there, and then the rest are on Microsoft Teams, and we're drinking that coffee with the Baileys in it or something, I don't know. Yeah. I go there to read on weekends sometimes. It's like this place. It's really sunny. Yeah.
I've had meetings there on the top floor.
Yeah, no,
Talk and hang out.
yeah, all day long. Yeah, when I go to the dentist, and then I still haven't eaten lunch. Yeah, advanced dental to the Gucci Martins and get that rotisserie chicken. Yeah, hits the spot for the. Not Portillo's is not an everyday thing, it's not. It's nice to get out. It's got off hour. I'd be at Barnaby's right now. That's just what I want. There's one in South Bend too, right?
Yes, and they're gonna open another one on Lincoln Way, Osceola.
I just happened to say it, not gonna get to the class now.
And you're completely, your forecast was perfect. But what's your weighted average cost of capital?
It was only about.
This is good, because I think for the final assignment, there's still more work on my behalf, which means you guys are gonna ask the questions on email and Canvas, and it's gonna be a good crystallization of the thought process. I can tell you, this feels right now like the real world. This really feels like a day in the life of a finance person. I think that's where you want to be. So you got that safety of the classroom where it's like, oh, this is a no-brainer. I can just roll this forward. That's not going to be reality. Although it feels a little bit too much of a white knuckle right now to really get by that company and value it. So maybe it's going to be somewhere in between the white knuckle and the comfort. That might be kind of how I'd match it up with reality.
Our final thing that we figure out next class.
Well, yeah, so the idea is to complete the final project by the last class, but that's only gonna be 2 weeks. Not enough time?
I think we can probably have that spreadsheet maybe to come back to class with.
Yeah.
The next thing, and then if you want us to take it a step further, we can do that before finals and turn it into you. for
Okay,
feedback or
So
something,
is there
or
a difference
something.
between finals and the final class? Is there-
Yes.
Oh, good. Good, because then that would give
Yeah, 'cause
enough time to turn this in for the finals.
finals week is the first week of May,
Right.
so there's still time for grades to go.
Right. And again, just so nobody has anxiety about grading, my grading philosophy is if it is done and done with heartfelt, this is what we did, then that's your A. And then if it's not done, there's gotta be a reason why. Then we talk about it. It's like, well, look, because this never was clarified. That's not even how I would think about it. I think about it as it's kind of like it's a final party. Where we just kind of look at this and celebrate. I'll wear my helmet, I'll look at this tire. Yeah, because if you guys, I can't let you guys recover from a formula thing, then how can you let me recover from that whack negative thing where it's like, oh, well, help me, so cryptocurrencies, 9,000 more, that's such a thing possible. That's not class topic. Crypto. I traded a little bit of it this year.
Bitcoin or?
Ethereum and a couple of them and
NFTs?
yeah, non-fungible tokens. Yeah, that's and a little bit of the what's the big one? Bitcoin. And then a couple of the small ones, and then this CPA work is like in the town I grew up in. It's like family CPA calls me up and says, "Okay, so did you have any sales of the cryptocurrency?" I'm like, "Yeah, I sold it like very quickly after I bought it, just for a little game." Okay, I'm gonna have to figure out how that works. So, probably a lot of people are doing that for the first time, like filing your tax returns. Like, okay, what happened if you did crypto? A lot of people don't know.
I haven't filed anything.
Okay. I might, yeah, who knows?
I commit tax fraud.
Well, or,
I'm not filing that.
well, it's kind of like if you do legal gambling, but back in the day, it's like, how do you report that?
Yeah.
Like you went to the horse track, made $500. What do you do? Yeah, I don't know. I don't know what the answer is.
You didn't prepare your
Knock
loss.
on my door.
Right, yeah, right, it was a loss.
Yeah.
Yeah, if it's not reported to the IRS, I'm not saying.
Yeah.
Yeah.
Okay.
You don't get a 10
Oh, so like I trade Robinhood and they actually do send you kind of your tax
Yeah,
information. Like, so
yeah,
it's supposed
are you
to
trading
report.
equities though, the stocks?
Yeah.
Yeah, okay.
And I don't report anything.
Well, I think they weren't reporting anything for a while too.
Yeah,
That might have been part of the reason I got.
Yeah, I just follow
Not
their
big.
rules.
Okay.
I mean,
As long as you don't get audited, you're golden.
I just follow Nancy Pelosi's trading tactics. It's good to go, right?
I don't know if I'll touch that one, but.
They got the microphone up there. Have you ever purchased an NFT though? That's really interesting stuff.
So I don't think Ethereum and Bitcoin are NFTs, but I think one of them was like the graph, and then another one was a little bit more Sushi Swap. I think those are NFTs because they trade against like the creation of like the solutions in like the meta world, and so that sounds like an NFT. It was interesting. It's very
wacky
volatile.
stuff.
Yeah, it was.
You think it's gonna like hang out? Like it's gonna be
It
for a while?
completely, I got lucky. It was like last summer and then it just completely deflated and it still continues to deflate.
Yeah.
So I don't know. I really don't know.
What do you think about crypto in general? You think that's gonna be?
The blockchain technology is legit. It's been used by financial firms forever for, your credit card is all blockchain. It's a concept of a unique number, unlocking another unique number can only match up to that. The security, I mean, that's real. And then apply that to like a limited supply exchange of value. I don't know if crypto is real money because it doesn't really hold its stable value over time. It's very, very volatile. But it certainly has a lot of value, the ones that are the Ethereum and the Bitcoin. It's just as an investment vehicle and as a store of value, I don't think either of them are good ideas. Okay. For day traders who have a high risk tolerance, I mean, it's interesting.
That's the people really getting behind it.
Yeah.
But it's the long-term investment into something like Bitcoin. Everybody's just nervous about because it's
Yeah.
It's the Wild West right now.
Now, Elon Musk is Tesla bought a good chunk of Bitcoin, like billions of dollars of it, so. You know,
Yeah.
I don't know.
He was tweeting about it and driving the price up.
Yeah,
Then
yeah, as long as your position's big enough in your Twitter account,
yeah.
a lot of followers, then you can keep it up by pumping it up.
What do you think about like AMC and GameStop?
Yeah, those are fly
GameStop
by night.
stocks.
I mean, just look what happened at GME.
Yeah. But did you follow that when they inflated it?
I did. So GME is at GameStop.
Yeah.
I mean, this was a wild west.
Yeah, this
Still at a really high price.
but I mean, like, look at that increase like, overnight.
This is insane,
Yeah.
absolutely insane. It's like anybody that just can't like figure out, it's like, okay, it was trading at like basically zero and then suddenly $300.
But they like destroyed the hedge funds, right?
They destroyed, yeah,
Yeah.
they're multi-billion-dollar hedge funds, those guys or gals were short. And meaning they needed the stock to go down.
Mhm.
And they shorted it maybe at like $50 and then went to 300, but that was their entire capital. Now they're just like, oh,
Yeah.
you know? Can't even afford Portillo's. Not even Portillo's.
But like, it was a big controversy because like they were doing it like Robinhood and stuff. And
Yeah,
then
Robinhood
shut it down. You couldn't trade.
No, that's risky.
That was a big thing too.
That's risky. I mean, then it's all the way up to 300 and all the way down to 50 and all the way up, I mean, that's just.
So like the hedge funds are betting against it and people just rally together.
Yes,
and drove
they
the price
squeezed,
straight
it
up
was opposite of a bubble. But yeah, so and then if you do the AMC, the same thing. Has anybody ever seen like the AMC in near Casapo Street and all kinds, like who goes there? Type it in. Great way to finish the last few minutes of class is to watch these equities crash. This gives us a taste of reality that maybe there's some humility to be garnered from this exercise. Well, what's going on? So COVID almost put AMC out of business. And then the short squeeze, you know, Tad, that you're talking about, that we're betting against the pros, higher than it's pretty much ever been. It's coming back down to earth. Where do I think it's gonna land? In the dog's house. I don't know.
It's about right there too.
We're in Fantasyland, right? Disney. Yeah. We're out with the tweet on Twitter. Anyway. I think that's all I've got tonight. So the next 2 weeks I think will be kind of essential in, communication, level setting expectations. I still don't know if I owe you guys another spreadsheet. I think I probably do, at least to tie into that market cap comparison. There'll probably be some questions about that. I think I'd recommend folks try to get started over, the next week to get their data in and spend the next week after that reaching out to me. I'm available for texts, assuming that my phone is working at the gym. It's at 38% now, so I charge it. I'll be in good shape, but email works fantastic. And then the Canvas, I think, shoots it to my email as well. So then I can reply to all. Note that I put the last homework in announcements. I might have put the first assignment in assignments, but so please check both, but definitely the announcements is where I'll be putting any new incremental things. I'll post this Zoom. Oh boy. Might be the end of me, but it'll be a fun out with the bank type of deal.
We can put a bunch of memes together and just have.
I mean, it's got the LinkedIn, it's got the screw up at the whack, it's got the putting the booze in the coffee. I've got a 79-year-old father with my same name, and he's got a financial background. He watches this stuff, and it's like that last class was great. Everybody, even during the break, it's like, okay, now I'm thinking about this. I don't know if the nephew, the 18-year-old nephew, the 17 going on 18. I think I said he was 19 last class. And sorry about that, Captain. But I wonder if he's watching, because he might say, look, you got my name wrong. You screwed up the formula. You don't know the present versus the future. Anyway, so no, I think it'll be a good formative final assignment. You know, come in prepared to talk. I mean, let's just spend the whole class next class 2 weeks from now talking about it, and then the final deliverable will, I guess we can deliver for the final exam, which is for the final exam time frame, which is within a week. I don't know, it's 2 weeks, whatever the schedule says or whatever.
From after the last class.
So we
Yeah.
We have
till
another
May
week.
6th.
Okay, so that's final exam time. You know, probably trying to get it done before that time so we can talk about it. It's probably a good. Because with 16 folks, we could probably have, you know, lightning round, you know, 15 minutes per person. Okay, here's blam, 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 everybody can get up, maybe log into their IU account.
But we could also send you the spreadsheets and then they can just, you can have them download.
Yeah, 100%. Yep. Have them all saved in one folder, pop them up. It's good when the market's closed, everything's calm. No flashing red and green. So, I mean, I hope the class is going in the right direction. I wanted it to go in the direction of reality. And I think we're grounded in reality insofar as we're getting our financial data from the places where we would expect them to come from. We're seeing the movements real time. We're seeing the struggles, you know, Lori, I know that it was woof, woof and Chewy, that's pet, and now it's gonna be drugs for dogs.
If I was smart, I would have said Portillo's.
Yes. Portillo's is not without its challenges because it doesn't have 5 years and it's growing and it might be a little bit loss making.
It's low right now.
Yeah, so
So that ended up for the best.
it ended up for the best, yeah. But the cheese sauce and the burgers and everything, can't go wrong, yeah.
It's like the crinkle cut fry, like picks up the right amount of cheese.
It does. Yeah, no,
Perfect.
it's,
No, the chocolate.
yeah.
Don't mess with it.
So you want times for shared outstanding,
This and what.
Yeah, so I owe you guys another. I should get it for you guys, but I don't know. Okay. That's good. It makes one of us.
So I know we're starting switching.
Awesome, and hit me up, for, you know, just our.
Okay, gotcha.
Because your style is to ask early. It's like I posted that stuff on Thursday, you asked Friday morning. Oh, okay, you know, and I did see your email yesterday, and then I did send it back to you.
He thinks I just did that.
No, I was. So you balance sheet, you get your shares outstanding here, and then
No,
so
it's
you want to
honestly,
match it up
I
with the
would-
period that's when.
So.
Well, this is Twitter, but you know.
Yeah, but I know it's.
Sorry, keep on Twitter on.
I literally was like, I have two screens.
And we'll just take
It's
one more time.
one column of. And so that's the one time, because you're not really like, working. So I was like, I can do this. Cause I was like, otherwise. I'm gonna do that. I don't know.
So here's your income statement, and then here's your balance sheet. So common stock authorized, ignore that, issued, 364,639, so they got 364 million. That multiplied by the share price at the time of measure, at that time.
So am I doing that for each year?
No, you're just doing it at the beginning of the period, so beginning
So
of
I'm
the
doing
period.
2018.
Your first year.
It'll be my first year, because I already did my sales for each of
So
them.
if you 2018 is your first year, how are you gonna do? So one, 19.
Oh, no, sorry, 27.
Yeah.
See you next
So-
week, next 2 weeks.
And so
Good.
for 2017,
That's not.
and that's gonna be published
Yes,
in
because I'm like not gonna do the back list. The one, like, no.
2017 is gonna be published in early 2018. Yeah, okay, no, here it is.
No, you didn't miss it, but it's actually, it's like I think it's like the 20th or something, and I was like, I'll forget.
There's your,
But it's like some of the questions. Like, do they present ideas in terms of SMART goals and I'm like.
cash flow statement.
This class has nothing to do with that. And it
So
was
here's your
like,
shares outstanding in 2017, end of 2017. So at the end of 2017, so 2017 is your first year, you want to use the end of 2016, so this should be 119 million. And then whatever the period end is, you want to match up the date, the share price of that date. So I don't know what.
So, or my fiscal year 2016 is
Oh,
October
okay.
to September.
So you want to say September 30th, 2016. And what the share price was on September 30th, 2016, and multiply it by 119,370,934 shares. That is going to be your market cap. You're gonna compare that to the results of all your DCF
Well,
stuff.
and the thing when
And
you
that's
got
gonna
it,
be where
when
you're
I got it, so it was like, I will never do it like.
Okay.
And I would never
And
like.
what's hilarious is that this is also being recorded, right?
Do the,
So you can actually
like,
watch this conversation.
That's
Oh,
and
and
then-
not my balance.
Yeah.
I think others might
That was on the
Yeah.
spot, it's
Yeah,
not
because
even
others-
about it. I just put that like,
trying to follow.
I felt like.
Yeah, no, it's hard.
Confusing and not having.
moving
feedback or
fast,
not having
and
people
also
for our surveys just
wasn't
stressing
up.
out. And then-
That's okay.
It
helps. Thank you.
And I'm like, this one is like a month late, give them a 0 and give the rest of us like.
Oh, you're talking about the.
Yeah,
It's on the 17th. Is one of those things.
I don't even know.
That we'll get the feedback for general one and two.